Hello, everyone. In the previous lesson, we studied the meaning and characteristics of financial risk and learned that financial risk refers to the possibility that economic entities may incur losses in financial activities, and that it is characterized by universality and contagiousness. Today, we will further explore types of financial risk to understand the specific manifestations and impacts of different types of financial risk. Next, we will conduct our study around the following aspects. 1. Market risk. 2. Credit risk. 3. Liquidity risk. 4. Operational risk. 5. Compliance risk. 1. Market risk. Market risk refers to the risk that economic entities may suffer losses due to unfavorable changes in financial market prices, such as interest rates, exchange rates, stock prices, and commodity prices. Interest rate risk is an important form of market risk. It refers to the risk that changes in market interest rates will cause fluctuations in the value of financial assets. For example, for investors holding fixed-rate bonds, when market interest rates rise, the market price of bonds will fall, resulting in losses for investors. Exchange rate risk is related to currency conversion and refers to the risk that changes in exchange rates will alter the value of assets or liabilities denominated in foreign currencies. Among ASEAN countries, Thailand experienced severe exchange rate risk during the Asian financial crisis in 1997. At that time, the Thai baht depreciated sharply, significantly increasing the cost for Thai enterprises to repay foreign currency-denominated debts, causing many firms to fall into financial distress. Stock price risk refers to the risk arising from fluctuations in stock market prices. When the overall stock market declines or the price of a specific stock falls, the value of stock assets held by investors shrinks. For instance, Indonesia's stock market once experienced sharp volatility due to domestic political instability, resulting in losses for investors. Commodity price risk mainly affects economic entities engaged in the production, trade, or consumption of bulk commodities. Taking Malaysia as an example, as a major producer of palm oil, a sharp decline in palm oil prices would have adverse effects on related enterprises and the national economy. This is a typical example of commodity price risk. 2. Credit risk. Credit risk, also known as default risk, refers to the risk that economic entities may suffer losses due to a counterparty's failure to fulfill contractual obligations as agreed. This type of risk is most common in lending activities. When borrowers are unable to repay loan principal and interest on time, lenders are exposed to credit risk. In the banking sectors of ASEAN countries, credit risk is one of the most important types of risk. For example, some small and medium-sized enterprises in Vietnam frequently default on loans due to poor business performance, placing pressure on local banks in the form of non-performing loans. In addition to lending relationships, credit risk also exists in the bond market. If bond issuers, enterprises or governments fail to pay interest or repay principal on time, bond investors will incur losses. Around 2020, government bonds in some ASEAN countries experienced credit rating downgrades due to economic downturn pressures, reflecting an increase in credit risk. Credit risk is also common in international trade. For example, when export enterprises in ASEAN countries conduct transactions with foreign importers, if importers fail to make payments on time, exporters face the risk of non-receipt of funds, which is essentially a form of credit risk. 3. Liquidity risk. Liquidity risk refers to the risk that an economic entity is unable to obtain sufficient funds in a timely manner and at a reasonable cost to meet asset liquidation needs or payment obligations. Financial institutions are particularly vulnerable to liquidity risk. When a large number of depositors withdraw funds simultaneously and banks are unable to quickly liquidate assets to meet payment demands, bank runs may occur. During the 2008 global financial crisis, some small banks in ASEAN countries experienced liquidity crises due to poor asset liquidity amid market panic. Enterprises may also face liquidity risk. For example, A manufacturing enterprise in an ASEAN country may encounter difficulties in capital turnover due to sluggish product sales, rendering it unable to pay suppliers and employees on time and thus falling into liquidity distress. 4. Operational risk. Operational risk refers to the risk of loss resulting from inadequate or failed internal processes, personnel, systems, or external events. Internal fraud is one manifestation of operational risk. For instance, employees of financial institutions may engage in unauthorized transactions or embezzle funds by abusing their positions, causing losses to the institutions. Some small financial institutions in ASEAN countries have exposed internal fraud incidents, which adversely affected their reputations and financial conditions. System failures may also trigger operational risk. With the development of financial technology, financial institutions in ASEAN countries have become increasingly dependent on information systems. Once system failures occur, transaction interruptions and data losses may result, causing losses to both customers and institutions. For example, a bank in Singapore once experienced a failed system upgrade, which rendered some customers' bank cards unusable and led to customer dissatisfaction. External events such as natural disasters and terrorist attacks may also give rise to operational risk. Thailand once suffered from severe flooding, which forced some financial institutions to close branches and suspend normal operations, resulting in operational risk losses. 5. Compliance risk. Compliance risk refers to the risk that economic entities may suffer penalties, reputational damage, or other losses due to violations of laws and regulations, supervisory requirements, industry standards, or internal rules. As financial regulation in ASEAN countries continues to strengthen, financial institutions that fail to comply with regulatory requirements will face compliance risk. For example, a securities company in the Philippines was fined by regulatory authorities for failing to disclose information as required, which also affected its business operations. Enterprises must also comply with relevant laws and regulations in the course of their operations, otherwise they will face compliance risk. For instance, in Indonesia, some foreign-funded enterprises were ordered to rectify their operations or had their business activities restricted for failing to comply with local foreign investment access regulations. This is a manifestation of compliance risk. Today, we studied the main types of financial risk, including market risk, credit risk, liquidity risk, operational risk, and compliance risk. Each type of risk has its own unique manifestations and impacts. Through relevant cases from ASEAN countries, we can gain a more intuitive understanding of these risks. Understanding the types of financial risk helps us more effectively identify and prevent risks in practical financial activities. That concludes today's lesson.